Equity markets have started off the year on a sour note, and U.S. stocks hit correction territory earlier this week. What is behind this weakness, and does it change our constructive outlook for 2022? Let's take a closer look. After a long period of calm in the market, it is easy to forget that market volatility is part of the bargain when investing in stocks and other risk assets. Historically, U.S. stocks have experienced a 5% correction every 10 weeks and a 10% correction every 34 weeks. The long calm in the markets led us to a 94-week period without a 10% correction, nearly 3 times the normal duration. We were overdue for a pickup in volatility. So what are the likely catalysts for this increased volatility, and what do we think about them? Recent market weakness can be attributed to a combination of concerns about rate hikes, economic growth, and corporate earnings. Additionally, there is concern about Russia's intentions towards Ukraine. The concern about interest rates seems overblown. Market expectations for the Fed funds rate at the December 2022 meeting have only increased modestly over the last month, and the 10-year Treasury yield is right in the middle of our 1.5 to 2% forecasted range. We think the Fed will manage its balance sheet with a strong aversion to inverting the yield curve. We think concerns about economic growth are inflated. U.S. consumers have $2 trillion of excess savings, and corporate inventories are near historic lows, both of which should underpin growth as the Omicron wave declines. The start of earnings season has seen some high-profile companies warn about their outlooks, including banks on costs and companies who benefited from the pandemic warning on future demand. We don't yet think these are valid read-throughs to the broad market and don't expect material negative revisions. We evaluate the outlook for geopolitical risks like the current Russia-Ukraine situation by assessing the risks toward global growth and/or inflation. Geopolitical risks tend to not have lasting impacts on asset prices. In fact, over the last 20 years, only one geopolitical risk became concrete enough to become a formal risk case for us. Maybe coincidentally, it was when Russia annexed Crimea. As developments there settled down quickly, this risk case also quickly disappeared. So what are the biggest risks we see to our current positive outlook? Number 1, persistent inflation that justifies a more hawkish Fed, and 2, a China growth disruption from their economic and zero-tolerance COVID policies.